What did I tell you about silver last time? I said watch 77, then 78.2 as the next resistance zone. We were sitting at 75. Look what happened. Silver smashed through 78.2 right before the FOMC minutes dropped at 2 p.m. Eastern. Then it pulled back to 76. Now we're trading at 77. If you've been paying attention, you already knew this was coming. Let me be crystal clear about something right now. I will never ask you for money. Never. I will never pitch you to invest with me. I will never run paid signals. I will never sell you a course. I will never offer mentorship programs. If you see anyone using my name or my face trying to sell you anything, it is a scam. Report it immediately. Block them. I make these videos because the truth matters, not because I'm building some sales funnel to extract money from you. This is financial warfare education. This is not financial advice. You need to protect your capital. You need to verify everything I say. And you need to stay far away from anyone who promises you easy money in this market. Silver is trading at $77 on Western spot markets. Futures are at 77. Shanghai spot is at 86. Shanghai futures are at 88. That's a $9 premium for physical metal in China. Gold is sitting at 4,979. Silver is up 4.3% today. Gold is up 1.6%. Bitcoin is down 1% as we're seeing this massive risk-off rotation accelerate across global markets. Now, I know many of you appreciated the call on silver breaking higher, but let me repeat something critical. That was not a signal. Calling price action is not that big of a deal. What I truly want, is for every single one of you watching this to become independent thinkers. Read the tape yourself. Do the homework yourself. Don't follow anyone blindly, including me. Be independent. I share short-term price movements because people ask me to, but I will not cover this in every single video moving forward. Because here's what's starting to happen. A very small but growing number of people have started expecting me to just tell them what happens next. They want me to give them the entry, the direction, the invalidation level, the stop loss, so they don't have to do anything except make money by following me completely. That is not happening here. That is never happening here. That is why whenever I share scenarios or price levels, I have to be extremely careful, because I know people do not respect risk management and they can hurt themselves badly. That is why I do not normally do this kind of thing. You've seen me in previous videos. I can call price in every direction, every single candle, every move. This is normal pattern recognition for me at this point. I don't even trade metals actively. Does that mean I cannot get it wrong? Absolutely not. It means I respect what the chart shows me. And you will get it wrong too. Guaranteed. You will be wrong. But if you watch the tape carefully over time, if you listen to what the market is telling you, it starts talking to you. These candles start speaking. You start seeing the story before it unfolds in the headlines. There is this blend of fundamentals and technicals that once you experience it, you know exactly what I mean. If you've experienced this, if you know what I'm talking about, comment below. Let me hear your experience. Let me know you understand this language. Now here's what broke in the silver market this week. Another 3.4 million ounces of silver were cleaned out of Comex vaults on Tuesday alone. Registered silver, the metal that's actually available to settle futures contracts, dropped below 90 million ounces for the first time in years. It's now sitting at 88.8 million ounces. Nearly every single vault was raided. Almost 2 million ounces were withdrawn from JP Morgan's vault. 587,000 ounces were adjusted out of HSBC's registered category. 345,000 ounces adjusted out of Brink's registered. Over 900,000 ounces withdrawn from CNT. 305,000 ounces withdrawn from HSBC. 541,000 ounces adjusted out of Loomis registered. 276,000 ounces adjusted out of Malka Amit registered. 1.3 million ounces adjusted out of StoneX registered. This is not normal. This is not typical month-end shuffling. This is a coordinated, aggressive pull of physical metal out of the system that is supposed to back paper contracts. And it gets worse. The Shanghai Futures Exchange just declared war on paper silver, effective February 27th. This is a major rule change that directly targets near-term speculative positions, and it's designed to protect China's critically low physical stockpiles. Here's what they're doing. Hedging positions in the delivery month and the month before delivery are automatically set to zero contracts unless you have a pre-approved special hedging quota. Only genuine industrial hedgers with explicit government approval can hold positions right up to delivery. Speculative longs or non-approved positions must roll out earlier or close their positions entirely. This slashes the pressure on immediate physical deliveries. Shanghai Futures Exchange registered silver stocks have plunged under 350 tons. That's the lowest level in over a decade. It's down 88% from the 2021 peak. Extreme backwardation persists in Chinese silver markets. Nearby contracts are trading way more expensive than distant contracts. This is a screaming signal of urgent physical demand. China is locking down scarce metal to prioritize domestic industry before their inventories run completely dry. This accelerates the shift of power. Paper manipulation loses its grip as physical control moves east. Same pattern, same sequence, same outcome. The silver rally continued after details of the U.S. critical minerals price floor plan leaked to the market. Silver is now up over $5 from the recent lows, hitting 77 on this news. This is a government-backed pricing mechanism that removes the paper market's ability to crash strategic commodities below production costs. At 9:30 a.m. Eastern Time, the Comex sent silver higher. Don't they know that 9:30 is usually slam time? That's when the paper market traditionally hammers precious metals lower with coordinated sell orders. They're nervous now because the masses just found out that silver producers aren't going to sell at fake paper prices anymore. We got so used to systematic price suppression multiple times daily that not seeing a single slam for over 12 hours starts feeling genuinely awkward, according to market observers who track intraday patterns religiously. The FOMC minutes that came out confirmed that rate cuts are coming. Several Federal Reserve officials said that cuts would likely be appropriate if inflation keeps declining as expected. Most participants warned that disinflation progress could slow, while the economic activity outlook remains stronger than expected. The market is interpreting this as a dovish tilt despite the cautious language around the inflation path. Lower interest rates are historically bullish for precious metals because they reduce the opportunity cost of holding non-yielding assets like gold and silver. But here's where things get genuinely terrifying. The Trump administration is escalating its positioning on Iran dramatically. Trump stated publicly that if Iran does not agree to a deal, the United States may have to utilize military bases in Diego Garcia and the United Kingdom. He warned that an attack originating from Iran could potentially strike the UK as well as other allied nations. In response to this escalating tension, the U.S. Air Force is deploying an additional 12 F-15 fighter jets to the Middle East right now. Crude oil is up over 4% amid these rising tensions. Officials have previously warned that this would not be a limited surgical strike. If this military action is launched, it could escalate into a large-scale, weeks-long war. With 20% of global oil flowing through the Strait of Hormuz, that critical choke point, any disruption there would send absolute shock waves through global energy markets and supply chains. This is not speculation. This is mathematical certainty based on geography and energy infrastructure. You cannot replace 20% of global oil supply overnight. You can't unsee it. U.S. debt is projected to reach $64 trillion over the next 10 years, according to Congressional Budget Office estimates. That's a $25 trillion increase in one single decade. The government will add roughly $2.4 to $2.5 trillion in new debt every single year. Even if there's no recession, even if there's no war, even if there's no emergency spending. Annual deficits keep widening from about $1.9 trillion in 2026 to roughly $3.1 trillion by 2036. Interest costs are projected to cross $1 trillion per year immediately and move toward $2 trillion plus annually within the decade. At that point, a huge portion of tax revenue goes just to paying interest on past borrowing. Not roads, not schools, not defense, just interest. Debt held by the public is projected to rise from 101% of GDP in 2026 to 120% by 2036. That would exceed the previous record set after World War II. But unlike the 1940s, this is happening during peacetime. This is happening when we're supposed to be in a strong economy. Not might happen, will happen. The world has reached the highest level of economic uncertainty in recorded history, according to the IMF's World Uncertainty Index, surpassing COVID-19, the global financial crisis, and the dot-com bubble all combined. This index measures global fear by scanning economic reports across 143 countries and tracking how often the word uncertainty appears in official economic commentary. For perspective, September 11th and the Iraq War barely show up on this scale. COVID in 2020 caused what was then the worst spike ever, hitting around 60,000 on the index. The current reading nearly doubles that. The main driver is the escalating global trade war, the massive wave of tariffs being layered on top of geopolitical conflicts, and growing doubts about Federal Reserve independence from political pressure. When uncertainty hits this level historically, businesses freeze. They stop hiring. They delay building new factories. They shelf expansion plans. They sit on cash. They wait. The smart money is leaving. There's a concept that precious metals analysts have been studying for decades about portfolio allocation during currency crisis periods, about how precious metals move from peripheral holdings to core positions as confidence in paper systems erodes. Current data shows that only 0.03% of global wealth is allocated to silver versus 0.06% in 2011. That is not a bubble. That is neglect. Silver isn't overcrowded. It's barely owned. In 2011, the S&P 500 was still below its 2007 peak. After years of sideways equity markets, investors looked elsewhere for returns. Today, equities are near historic highs again, while silver allocation sits at half the 2011 levels. What fascinates serious market analysts is the 1980 allocation level. After 14 years of a sideways Dow Jones from 1966 to 1980, silver allocation must have been far higher than 0.06%. If we knew that exact number, we would have a better framework for understanding how long this current cycle can run before exhaustion. Not opinion. Pattern recognition. Gold is back at 5,000. Silver is at 77. When gold first broke 5,000 recently, silver broke above 100 briefly. Silver is insanely cheap on a gold-to-silver ratio basis, according to metals traders watching relative valuations between the two monetary metals. 3 million ounces were pulled from registered inventories and taken completely out of the vaults on Tuesday. Not just shifted to the eligible category to sit there. Taken out completely. The total silver available to settle futures contracts drops to just 88 million ounces. March contract settlement begins in days, with massive open interest still not rolled forward, creating delivery pressure that intensifies as the clock runs down toward first notice day. The ones who verify data independently, who pull vault reports themselves, reach the same conclusion. This is unprecedented withdrawal velocity, this close to contract expiration and first notice day. Let's examine the bearish case honestly, because you need to hear both sides. Iran tensions could de-escalate, removing the geopolitical risk premium from commodities. The FOMC's dovish tilt might already be priced into precious metals. Disappointment is possible if rate cuts get delayed again. China's Shanghai Futures Exchange rule changes could force speculative long liquidation, creating temporary downward pressure on price. U.S. debt projections assume a baseline scenario without crisis. Markets may not react to debt numbers unless an immediate crisis catalyst emerges. The uncertainty index is elevated, but it hasn't triggered an immediate economic contraction yet. Mining and metals allocation is underweight, but that could persist if institutional capital stays concentrated in AI stocks and technology. Silver allocation is historically low, but it requires a specific catalyst for rotation to occur. Technical price targets have been hit. That doesn't guarantee continuation higher. This is financial warfare education. This is not investment advice. You need to understand both sides. But when you look at the complete picture, when you step back and see the whole chessboard, here's what you're staring at. 88 million ounces of registered silver with massive March contract open interest. China implementing rule changes on February 27th specifically designed to protect domestic stockpiles. The United States implementing a price floor mechanism that removes paper manipulation's primary weapon. The FOMC confirming a rate cut path that historically supports precious metals. A debt trajectory that is mathematically unsustainable, requiring $64 trillion over the next decade. Global uncertainty hitting all-time record highs across every measurement. Iran tensions building with the potential for large-scale military conflict within weeks. Oil up 4% purely on geopolitical risk. Silver allocation at 0.03% versus 0.06% in 2011. showing a massive institutional underweight position. Every single Comex vault getting hit on Tuesday with accelerating withdrawal velocity. Gold back at 5,000 while silver sits at 77, creating what many view as a valuation opportunity. Technical levels playing out exactly as forecasted, giving us a framework that has proved accurate so far. The informed minority understands the blend of fundamentals and technicals. They watch how the chart telegraphs what's coming before it arrives. They respect risk management. They do their homework independently. They don't follow anyone blindly. They verify everything independently. They understand that calling price isn't magic or mysticism. It's pattern recognition earned through thousands of hours of screen time and deep respect for what the tape is telling you. The ones who do their homework, who put in the work, start to see these candles talking to them long before the story unfolds in the mainstream financial media narrative. We are not at the cliff. We have already walked off it. The question is not whether the ground is coming. The question is how far the fall is and what you're holding when you hit. This is a wealth transfer. Not might be. Is. Wealth transfers from those who hold paper promises to those who hold physical assets. Gold, silver, land. Real things that cannot be printed, that cannot be debased, that cannot be inflated away by central bank policy. The pattern has repeated 3 times in recorded history. The Roman Empire debased its currency to pay for wars and welfare until the denarius became worthless. Verified. The Dutch Empire financed endless wars with debt until their guilder lost reserve status and their empire collapsed. Verified. The British Empire printed pounds to fund 2 world wars, lost reserve currency status to the dollar, and watched their empire dissolve within a generation. Verified. Same pattern, same sequence, same outcome. You can't unsee it once you understand the cycle. We are not in the early stages. We are in the final stage. The mathematics are certain. The timeline is compressed. The outcome is not in doubt. Only your preparation is in doubt. Invest with logic, not hype. Do your homework. Verify everything. Protect your wealth. And subscribe for more insights as this unfolds, because this story is just beginning.